Welcome to the BankLite strategy overview. We will be discussing how to create additional tax-free wealth and income by changing where you store your money and how you access it. While most people store their money inside of a bank account, savvy investors, business owners, and individuals, once educated, will make the change to storing their money inside of a banking policy as often as possible. When using a banking policy, there's three different ways that we create the result of tax-free wealth and income. Number one, by storing your money inside of a banking policy as an investor, it allows you to double dip on your investments. Every dollar that is placed inside of a banking policy begins growing tax-free, protected from risk, and when it's time to access the money, you can do so via a guaranteed policy loan from the insurance company. This means that your money stays in the account, continuing to earn uninterrupted compound interest while you use OPM or the insurance company's money to go make the investment. This effectively means that every dollar in the policy that you then use for an investment is now $1 multiplied into two, working in two places at one time, once in the policy and once in the investment. Number two, when using a banking policy, you can turn your major expenses into an asset even after the expense is paid for. Let's take taxes, for example. Every year, if prior to paying your taxes, you stored your money that you are going to use for paying your taxes inside of a banking policy, when it comes time to write the check to the IRS, your money never actually leaves the account because we use the policy loan to pay the taxes. Even after those taxes are paid, you are still earning interest on that money permanently in your policy for the rest of your life. And finally, number three, you can escape the banks and institutions and never pay interest to the bank again. Eventually, you accumulate so much money inside of your banking policy, you're able to write any size loan from yourself to yourself and paying yourself back as if you were the bank. At the heart of a banking policy and a private banking strategy lives the insurance contract. The insurance contract is where we store our money before we use it. Let's say you have your pool of money, your cash flow, your liquidity. We are going to begin storing that money inside of a properly structured banking policy, which in this case, we would use a maximum funded index universal life insurance policy. This is a very particular type of product structured in a very particular way, maximum funded, minimum death benefit, with a very small handful of insurance companies that we would actually use. The reason why we store our money inside of a max funded IUL is because the IRS says so long as a portion of every dollar pays for a permanent death benefit, the rest of your money can sit inside of an account value that grows and is accessible tax-free. This account value that is tax-free has guarantees against risk from the insurance company. It protects your money. It's safe just like the bank. And in the last decade or so has earned about an 8% average return. But what turns it into a banking policy and a private banking strategy is the guaranteed ability to access other people's money, in this case, the insurance company, by borrowing against the account. These are loans from the insurance company that you having the contract itself guarantees the ability to borrow. You do not have to qualify for the loan when you need it. These insurance policy loans in a max funded IUL with reputable insurance carriers are like a good employee, because like a good employee, the policy loan earns you more money on average than it costs you. As you begin storing your cash flow, your cash, your liquidity inside of the policy where it's growing at a 6 to 8% average return with guarantees against risk, tax-free, etc., and you can borrow from the insurance company at 4 to 5%, your money is earning more interest on average than the cost of the loan. That means that the interest that you earn inside of the account pays it on its own. Additionally, the loan itself does not actually need repayment. Because let's say you have $1 million in your policy and you borrow $500,000 from the insurance company. If you die tomorrow, the insurance company is simply going to deduct your outstanding loan from the value of the account, which means that you get to benefit from the use of these policy loans until the day you die, at which point the insurance company will settle up. Any equity left in the policy plus the insurance amount itself, the death benefit, will be paid out to your family. This realization about the value of the loan is pivotal because it means that this loan inside of a policy is not actually a liability like most loans. This loan is actually an asset because it earns you more interest than it costs you. Now let's go through an actual client case study. Now this client is both a business owner and an investor and had accumulated a sizable amount of liquidity inside of the business. They were sitting in a high yield savings account paying 2 or 3%, effectively losing to inflation over time. So we structured that money into 3 payments of $800,000 per year into a max funded IUL policy that he can use for a private banking strategy. Now, if you recall, about 10 to 15 cents of every dollar pays for the actual cost of the death benefit, so the rest of your money can grow tax-free, which means that in most IUL policies, you reach a break-even point where you have more money in the policy than what you contributed. Usually happens somewhere between year 2 and year 4. In this client's case, that means that after 3 years, his account value was right about $2.4 million. So while this $2.4 million was parked inside of this client's policy, March 2025 comes around and he sees a good buying opportunity in the stock market of NVIDIA, priced at $95. What this client client did was access his liquidity via a policy loan to the tune of $900,000, while his entire account value of $2.4 million stayed inside of the account, continuing to earn interest. He then took that $900,000 policy loan, he purchased NVIDIA at $95, and just 6 or 7 months later, that $900,000 was now worth $2.1 million, over a 100% return on his investment. Now, the point of this example is not the investment itself. The investment could have done well, the investment could have done poorly. The point of this example, while he used this $900,000 to buy NVIDIA and get a 100% return, he earned an additional $230,000 on his account value for the year. So the $900,000 actually had a gross return of a little over $1.4 million, $1.2 million of which was the actual return of the investment buying NVIDIA. An additional $230,000 was because he placed his liquidity in the policy prior to making the investment. So now $2.4 million in the account value now grows to over $4 million. And rather than paying the $900,000 back directly, if he puts that into the account as new money, now he is earning interest off of that $900,000 loan, plus the $900,000 he returned to the account. This is just one example of how to use a banking policy in a private banking strategy. The real goal of a banking policy is to build the tax-free wealth and income by passing as many dollars as possible through the policy over the course of your life. So ask yourself this: if you were to add up all of the dollars that pass through your hands throughout your life, all the money you make, all of the money you spend, every single dollar, that amount may be hundreds of thousands, millions of dollars, or even tens of millions of dollars. A banking policy allows you to earn interest on every single one of those dollars for the rest of your life, completely tax-free. I hope this video was very helpful for you. The next steps would be to book a consultation with our LiteStrats team. In our consultation, we will run through more education, more examples, answer all the possible questions you have. This process of setting up a banking policy, between the education, the approval, and the actual setup, can usually take about 2 to 3 months. And so we have plenty of time to make sure that you're fully aware of how this policy works, all of the pros and cons, dispel any myths that exist out there on the internet. And then finally, inside of your consultation, we can run your specific numbers so that you can understand the benefit of you and your family using a banking policy rather than just some hypothetical examples. If you'd like more information on us, our company, our website, the strategies that we use, you can visit LiteStrats.com. You can also check out our YouTube and our TikTok at LiteStrats and at FolgersBro. Again, I hope this video was helpful for you. I look forward to seeing you very soon.